Welcome to Turtle Talk. Dive into the fascinating world of timeless trend-following strategies and the pursuit of the elusive outliers made legendary by the turtle traders. Join your hosts, Adam and Rich, alongside our esteemed co-host, Jerry Parker, as we uncover the powerful principles of classic trend following. From counterintuitive practices to the mechanics behind capturing market outliers, each episode offers a masterclass in navigating the financial markets. Expect in-depth discussions, expert insights, and actionable advice to help you master the art and science of diversified, systematic trend following, turtle style. Tune in every month as we explore the dynamic and ever-evolving world of trend following, equipping traders and enthusiasts with the tools to succeed. And now, without further ado, let's hand it over to your hosts, Adam, Rich, and Jerry.
G'day, and welcome to episode 13 of Turtle Talk. I'm Rich, coming to you from Brisbane, and I have to say, it's absolutely wonderful to be back for Turtle Talk. Adam and I have just returned from a few weeks in Malaysia. What a place. The food, the people, the warmth, the colour, it exceeded every expectation. I could have stayed another month without any hesitation whatsoever. So, Adam, you were there with me. Tell the listeners a little about the experience and what were the highlights for you.
So another great trip for us. I think we've been back a few times now, and it's always good to be back in Southeast Asia. There's just so much energy and excitement, and there's always something new, whether it's a new building popping up or a new restaurant. And I think this time around we did less touristy activities, which allowed us to really get into some of the, make a few more social and business connections as we expand our footprint in Malaysia.
Yeah, a really vibrant place. Anyway, joining us, as always, from Tampa, Florida, the one and only Jerry Parker. Jerry, how are you, cobber? Have you been doing any travelling yourself lately, or have you been firmly planted in Tampa, keeping an eye on the markets?
I've been keeping my eye on the markets in Tampa and a little bit in New York. I was in New York a few weeks ago, and it was pretty rainy and cold, so I'm glad to be back here in Tampa. But I'm jealous of the Malaysia trip. That sounds like it's going to be a lot of fun. I've never been there before.
It was a ripper. And
well, who knows, Jerry? Maybe Kuala Lumpur trip is in your future.
Yes, I'm sure. One of these days.
So one of the things I love about this podcast is that every episode feels like catching up with old friends who just happen to understand markets better than almost anyone else on the planet. So today that feeling is amplified because we have a very special guest joining us. He's based in the greatest city in the world, New York City, one of those places that just never stops moving, never stops generating energy. Mike, welcome to Turtle Talk. I have to ask straight away, how is New York treating you right now, and what's the weather like up there?
The weather is finally good. We've had, I think, 3 winters this year. It was the worst winter I could ever remember. I grew up in New Jersey, about an hour south of New York, so the same weather, and this has to be the worst winter I can ever remember. And the second worst was last winter, last year. So it's lovely to get out in the park with my little 4-year-old who is a sports lunatic. So we've been having a ball lately.
As I say, like father,
downtown.
like son.
Yeah, he's very intense. He's already chipped my tooth playing tackle football, which he insists that we play tackle football in the house. So he's running me ragged right now. But it's fun. It's fun, and New York is finally nice. We finally get to go outside, and I think I was wearing a sweater and a coat through halfway through May. That's ridiculous. That's absolutely ridiculous. Yeah.
We're getting a similar thing over here in Australia, really weird weather, so we can't understand it ourselves, but it seems to be common throughout, extremes everywhere.
extremes for sure. Yeah.
Look, for those of you who haven't come across Mike before, let me tell you why we're having him on this show and why it feels so natural to us. So, in the world of trend following, there are many who claim the title. But when you look closely at what people are actually doing, how they size positions, how many markets they trade, whether they are chasing sharp or chasing outliers, the number of managers who are genuinely uncompromisingly classic trend followers is remarkably small. We're talking about a handful. You can count them on one hand. Mike Melissinos is one of them. He's the founder of Melissinos Trading, a systematic trend following firm. He launched back in, I believe, 2011. Correct me if I'm wrong,
Correct.
Mike. Same system, same rules since inception. No drift, no compromise, no watering it down for institutional palatability, just classic trend following. The way the original turtles under Richard Dennis and Bill Eckhart intended it. So he is the founder of Melissinos Trading, a systematic trend following firm. And having Mike in this conversation feels so completely at home with Jerry, Adam, and myself. Today, we've got him sitting across from us. He's lived it, he's built a firm around it, and is right now delivering the kind of returns that prove the point beyond any doubt. And we'll go into that later in our discussion with him. He's really hitting it out of the ballpark at the moment. So, Mike, before we dive in, I've got to ask, have you been doing any travelling yourself lately, or has the current market environment had you firmly anchored at your desk in New York?
Well, with trend following, you don't really need to be anchored to the desk really at all. I think if you're doing it the classical way, I mean, you could be if you want to watch it and stuff like that, and maybe that's a habit that keeps you out of trouble. But traveling, well, we went to Turks and Caicos over the winter with the little guy. We also went to Disney. You know, it's our second year at Disney, and that seems to be it's an annual thing until he burns out of that. And we're actually going to go to Portugal in the summer, just for a few days, in the Algarve. I've never been to Portugal, but my wife has, so it'll be a return trip for her. And then the sexiest trip that we've taken recently has been when my wife turned 40. Yeah. So we went to the French Alps for skiing. Yeah, that was. I told Jerry all about that hotel.
I listened to your pod with Jerry where you were talking about it, and wish I was there, mate. That sounded fantastic.
Oh man, yeah. I mean, you get to ski and not spend an arm and a leg. Where in the States, you kind of what you'd spend in the States. Let's say in Utah or popular places in Colorado, you would spend per day what you would spend in Europe per week for skiing. That's like lift ticket and all those things. So the States has gone a little out of hand. And plus you get good French food and you get Italian pasta. I mean, come on. I mean, it's just a long flight. It's a long flight. That's all.
A couple of episodes ago, I think Jerry was telling us he spent time in this ice castle in Sweden. I thought, gee, that's hard to beat. But Mike, it sounds like your French Alps is pretty close.
Yeah, that sounds nice too. Yeah, get to see like Northern Lights and stuff like that. Yeah,
absolutely fantastic, mate. So here's what we've got in store today for this podcast. First up, Adam's going to take us through the Battle of the Trends for April 2026. The Classic Trend Index has had a stellar month, and there's plenty to unpack for this episode. Mike will be asking you for your read on the numbers as well as we step through that. Then we move into what's moved the needle, the market action and the standout charts from Jerry, Adam, and Mike. And after that, we go into the main event of this show, our spotlight conversation with Mike, and we're going to deep dive on his journey into trend following, his philosophy, his connections to Ed Secota's trading tribe, and the reasons behind his stunning recent performance. So then we have Mythbusters, two myths this episode, one led by Jerry and the other by Mike. And this is going to be a lively one. And we also have a shell mail question from a listener on the cutback rule. So, Jerry, I'll be needing your help here. I think that's going to spark a very good debate among the four of us. And Mike, I want to know if you use it as well. And finally, we'll wrap things up. So without further ado, Adam, take it away with Battle of the Trends.
I'm going to keep it a little shorter this month because we've got Mike on. And so, my head is still kind of spinning from April. I see here you've broken it down by the week. Week 1, tariff shock and commodity explosion. So, as that week title describes, oil price up massively. Then you've got week 2, the ceasefire reversal. Obviously, crude is down then again massively. Week 3, we've got the trend cycle re-engaging and more volatility in these commodities markets. And then week 4, the Straits close again. And we get a rally in energy and then a fall in the metals markets. So a real whipsaw for markets, but actually the trend following systems held up really, really well. Well, thank goodness we did not crash and burn in April, and we have the whole spectrum of trend following programs performed well in the month of April. I see here classic trend index up 6.7%, which is obviously a fantastic result. I think reversing a slightly down number from the previous month. And we did, in fact, have the highest return versus the benchmark, the peers that we benchmark against. And so that is very, very nice. And the year-to-date and quarter-to-date performance is looking good. You can see there on the chart a continued outperformance relative to the peers, not just nominally, but on long-term risk-adjusted measures, whether they be MAR or Sharp or Sortino or whatever those other performance metrics that you want to look at. And it's just nice to be coming into the end of our fiscal year, which is a June year in Australia for reporting. We're coming in with some pretty good numbers, which I think all the investors are going to be happy with, apart from having to receive a distribution, which will have some tax impacts, but you can't avoid the tax man in this business. So that's pretty much a wrap for the classic trend index.
Perfect. Look, this is something I just want to jump in and say is that, April's result as it is a slender statistic. It can't be used to assume what we're going to get in May or whatever. But what I want to talk about is more the long-term position here, because I think that VAMI chart is telling us something much deeper than just a good run of results. So if I look at the separation between the classic trend following index and the rest of the mob since January 2020, that gap is not narrowing, it's widening. And I want to explain what I think is happening and why I think it may continue for some time. So the period since 2020 has been extraordinary for one very specific reason. It is what I call amplified convexity and it's punished smoothness. So in this period, we've had a global pandemic, an inflationary shock, an energy crisis, a geopolitical fracture, and now a world where supply chains, interest rates, currencies, commodities, they're all moving in ways that reward those who are positioned for outlier moves. So I call this the shift from smooth world, which is the prior sort of decade before following the GFC, into rough world from 2020 on. I call this a shift from smooth world to rough world. So for many years, these CTAs made a rational business decision. They tampered with their system, smoothing the return profile, cutting volatility, managing drawdowns more tightly to make their offering more palatable to institutional investors. Lower volatility, they wanted to improve their Sharp, easier to sell. It made commercial sense at the time. But there's a problem there because when you smooth the return profile, you're not doing it for free. you're paying for it with your convexity. You are systematically trimming the outlier trades, the very trades that define what classic trend following is. And in smooth world, you might get away with it. But in rough world, you pay a very steep price. So the rest of the mob who are diverging, we're diverging away from them. The rest of the mob, they're competing in a world that's actively punishing that compromise they've made. And to make it worse, they're also being squeezed from the other direction by the lower cost replicating products that can approximate their smooth, modest return profiles at a fraction of the fee. So if you have given up your outliers to look more like a bond substitute, you're now being competed away by your own cheaper cousins. So classic trend following, what we do, what Jerry does, what Mike does, has not made that compromise. We've kept our convexity intact. We've stayed wide. We've stayed systematic, stayed patient. And the results since 2020 are showing exactly what happens when you do that in an environment that rewards it. So here's the thought that really excites me. The rise of passive investment is accelerating this dynamic. As more capital flows into passive equity strategies, market pricing becomes less efficient at the single stock and sector level. Correlations shift, and the macro trends that systematic trend followers exploit actually become more pronounced and more persistent. We may be entering an extended regime, not just a good run, where classic trend following starts to depart from the mob and generate material geometric wealth for those who stayed that course. So that's a particular point I want to take. And visually, you can see it from 2020 in that VAMI chart. Thoughts, gentlemen?
I couldn't have said it better myself. I think I'll hazard a guess that our product or classic trend index is probably highly correlated with Mike's program. I know that we're both doing a similar style of trading. I don't know, Mike, if you want to talk to your recent results and how you're viewing the whole trend following scene at the moment without biting into the future spotlight that we're going to do.
So what a difference a year can make. I mean, last year, this time I was not feeling very good. It was around the time me and Jerry had some coffee in New York. And we were just kind of hugging each other like it's going to be all right after the tariff stuff. And that was a painfully annoying time because I had, since COVID and around that time, I forget, something else happened, but I was making that conscious decision to, because I was trading in maybe a more mediocre, middle of the road aggressiveness. The heat levels kind of okay, maybe higher than your big firms in Europe type of thing, but not as high as it should be. And I said, I'm making a mistake here. This is not who I am, and I'll get to all this too when I talk about Ed and the trading tribe. This has kind of been my journey to it. And then, okay, I got to the finish line of the new heat level I wanted to get to, trading at a higher vol, then tariffs. So
yeah,
it was
that Liberation Day, Mike. Remember April? That was painful.
Yeah. So I lost 25% in that month, April, that month alone. So I think at one point year to date I was down 45. So I was like, okay, welcome to high heat. Trend following. Here we go. But I say, well, yeah, what a difference a year can make because performance has been really strong since that time, and it led with the wave of the metals, the precious metals, and year to date this year, it's still been metals and now energies are contributing pretty strongly the last couple months. So, I think when we get these periods of, especially I see the gap between the pure trend where we're not fidgeting with the position sizes and things like that, and the guys that do, in a good period for trends, of course we should separate, and we hadn't had I guess like a long enough period for that to kind of play out. But I guess we have, since COVID, because maybe the 5 years before that, 4 years before that, it was tough, no matter what you did. And I think the massaging the positions, it worked better during that time because we just didn't get a whole lot of big moves in that 2015 to 2019, 2018 sort of period. That was a tough period. So it's nice to see. Now that we're getting some moves that this is what you get. You get some separation because we're sticking with these things.
Jerry here. So his experience. So my experience sort of spans probably a similar distance as yours, Mike, and Adam's as well. But let's go to the master himself, Jerry. So Jerry, you've been in the game for a long time. So is this environment we're in now reminiscent of the environment you were in the 90s, the 80s, 90s, 2000s sort of thing? Is this a sort of similar environment? In other words, what I'm trying to say here is that perhaps 2008 up to 2020 was the anomaly here, the sort of, volatility constrained environment, lack of trending possibility, causing CTAs to focus on, smoothing. Is that a possible explanation for what we're seeing here?
I don't know. I just think I can't remember really if this period reminds me of other periods. We certainly had a CTA winter there for a while. I do think that the big question in my mind is during a period where stocks did so well and stocks trended so well, why didn't CTAs do better? If we had a period like that where the commodities kicked ass for almost every year for 10 years, we would be loving that and saying, wait a second, yeah, we crushed it, right? Well, wait a second, one of the 4 sectors that we trade is stocks, and stocks crushed it, but I just wonder if because CTAs trade indexes that limit the ability to have outlier moves, or they don't trade enough stocks to begin with. They don't trade 25 to 50% stocks anyways. So I think that's probably goes a long way. We had trends, we just didn't maximize them. We're stuck in the indexes, and we're stuck being a part of the portfolio of stocks and bonds, so don't get in that way. Maybe there's some people who even float the idea that CTAs don't need to trade stock indexes at all because clients already have stocks. So obviously I'm against all of that. So I think it's an opportunity to look in the mirror and say, wait a second, how can we go during a period where stocks just crushed it, trend following crushes it with trends, but we didn't do very well? Do we need 2 big sectors to go all the time? 3? Or is one enough? I think that's a research project someone needs to do.
That'd be a good one. Gents, any more to say about Battle of the Trends?
Well, we're not doing well in 2026. We're not in first place. That doesn't feel good. So we got to pick it up. Why do you think that is, Rich? What specifically? Where do we mess up with our strategy?
Well, we did get a whopping drawdown, the classic guys, which is the price of admission. I don't necessarily think we can make any judgment about how we're going to finish off at the end of the year, but I think our convexity is still intact. But with convexity, when I'm talking about convexity, you inevitably face the drawdowns to achieve the returns we deliver. So rather than the smoothing mechanisms, which is sort of reducing the loss function, I think when we do get our drawdowns, we certainly get doozies, but reliance on these outliers to lift us out and then some, I think is how we achieve our geometric returns. But Jerry, nothing really to comment on. I'd say when we look at how classic trend following is doing, now we are accelerating back very fast to our high water mark. We probably have achieved that already. I know Mike's probably whipping through his high water mark already. I'd say you are as well. We're coming close to it. So we did have that drawdown a few months back, but we certainly are coming back fast, and that's because of this acceleration. You know what Dave Dredge talks about. We're the system, we're the racing car that's got the good brakes that allows us to mitigate adverse volatility, even though we do cop the drawdown, but accelerate out of it very quickly. Yeah, that's how I see it.
Well, Rich, I mean, and to Jerry's point there, I mean, perhaps in this very short period of analysis, right, because we're only 4 months into the year based on that April close, maybe the vol scalers were able to get a few oil contracts out or energy contracts out on a vol spike and reduce their exposure to energy. Whereas at the end of April, we're not at the highs for those energy products.
Yeah,
so could that explain the relative outperformance?
Yeah, we've been victims of the taco flips over this period, the continual readjustments, the vol scalars, the dynamic position sizes. Of course, that would be minimised for them, but we're relying on these persistent trends. Now, we've had some great persistent trends. Gold, the energies, we've had some persistent trends there, but we have had these significant flips as well. So during these periods of uncertainty, specifically led by geopolitical flipping, it does make it a system pretty hard to navigate. So I think it's a necessary requirement for the particular systems that we are using. This is a natural outcome of it. So I don't think it's anything to be worried about. I think that ultimately we will be latching on to some significant big trends coming, especially with this rise of passive and all of these sort of things. So I think over long cycles, I think we're positioned to be, take advantage of that opportunity. But, over this short term, as you're saying, Adam, it's difficult to get any definitive conclusions out of it.
Well, yeah, like you said, that VAMI is just diverging, and it continues to diverge. So even if you have a small period of time where it is not diverging, I guess the expectation is that it will or it should, without giving financial advice. I think that's the expectation that us classic trend followers are operating under. But anyway, the future will tell the story, I guess.
All right, gents. So let's close off on Battle of the Trends and now move on to what's moved the needle. So this is where we look at the live market action and the charts that have been catching our attention. And we've got some great charts this month. So, Jerry, I'll start with you. Can you lead us through your charts and what you're looking at?
Yes, I thought it was a good idea to bring up the idea that the Australian dollar is very strong. It's one of the strongest currencies out there. I didn't really try to compare it, but I know the China yuan is pretty strong, and that maybe the Israeli shekel is number one, but Australian dollar is doing pretty well.
We're not sure why.
It could just be.
Come on, Adam, a bit of nationalistic pride, please.
Look, love the country, but the budget of last month. I mean, it was absolutely shocking. I can't believe the Aussie dollar is still where it is, but it could just be the best of a bad lot, But the interest rates in Australia are probably higher. I look at the chart, and maybe the downtrend in Aussie rates is a bigger downtrend, and it's been downtrending longer than the other ones, even though we had some sort of a bond market rally this week. But so that's pretty interesting, that it's doing so well. And then I thought
We could talk about how we don't have to limit ourselves to versus the dollar or versus the euro. You can pair the Australian dollar with New Zealand and Canada, and you get some even bigger trends and a little bit different chart pattern. Maybe the Aussie dollar maybe had more whipsaws over the past few years, as evidenced by the chart. But so you get some diversification and some by trading multiple pairs like this. You get a different entry ATR, which could make maybe if you get two markets that are probably pretty highly correlated, New Zealand and Australia, you get a bigger position because it's correlated and the ATR is smaller. So I think there is a big benefit, and there's 50 other pairs you can trade: euro, sterling, Swiss yen, all kinds of different things, but different chart
really
patterns.
Into the crosses, aren't you, Jerry?
I love the crosses. They're fantastic. I've had clients tell me, they would open up this, they would come in and look at the markets and see the currencies getting trashed, or the position in the CTA's positions being trashed, and then just knowing all the time that Chesapeake had those positions, but also had some of the currency crosses on as well, so as to not be entirely impacted just by what's happening versus the dollar. So I'm a big fan of these crosses. It's more diversification, and no reason to hesitate, and no reason to not trade two markets that are highly correlated, that never break apart and never have a trend because they're managed. Shut up. No. We're on this planet to make money in markets and during periods where what's happening has never happened before. And so there was a trade I had on back in the 90s. It was German mark versus French franc. And the mark didn't really go anywhere versus the dollar. The franc didn't really go anywhere versus the dollar. But the combination was a huge monster trend because the ATR was low and it was so highly correlated, it didn't take much of a breaking of that correlation to produce a big, huge trend. Don't forget your currency crosses.
Yeah, good point.
Good one.
Mike, any thoughts on Jerry's charts?
The Aussie dollar's been a big winner for me this year too, as far as currencies go. But overall portfolio, it doesn't crack the top 5, that's for sure. But it's been okay as far as a nice long trend in the Aussie futures. So I do agree with the not pairing everything versus the almighty dollar, because that assumes there was once a time where the dollar was not around, and there might be a period in the future where it's not around. So that's part of keeping the door open, keeping an open mind, keeping your maximizing your opportunity set to what's available. And I understand there could be practicality purposes and things like that. It's easy to trade the futures or liquid and stuff, and if you want to trade pairs, you got to do some extra work, extra math and things like that to make that happen. And that people, might be a barrier to entry. But there's don't sneeze at it. There's opportunity there that I think can be exploited, even if it hasn't been exploited in the past. Right? Just like what Jerry said, doesn't matter. We're open to, if something like this happens, we can capitalize on it, and that's what we're open to. Being trend followers. We're not. We're trend follower on the 50 most liquid futures. No. We're trend followers. Period. Let's find it, and try to capitalize. And I guess we'll get that into the chart that I provided for you guys too, and getting outside the box of some wacky moves and that are out there that people may not be familiar. Yeah.
Mike, I was thinking, your notion that there's a bit of extra work to do to go into cross currencies, etc. It's a similar story to there's a bit of extra work to go into stocks, into trend following, corporate actions, all of these things, stitching it all together. That's probably one of the main hurdles that stops a lot of people.
I agree.
Keeps them in their indexes.
Yes,
and doesn't
I
go
agree.
into the stocks.
Yep. Well, that's just opportunity. Just go a little bit further down the road.
You should
dig a little deeper. You might find that gold. People give up. People give up before they get to it.
So, Mike, tell us about your chart. This SanDisk.
SanDisk. I mean, it has to be it has to be the best performing instrument out there, at least over the last year, 6 months to a year, right? I over the last year, it's up over 4,000%. That's 40 times. So, in the last 6 months, it's up 1,000. So, SanDisk has a long history too. They've been around. They've been a stock, and then they were bought. I forget by who, someone, and then they were spun out, and then it became public again, kind of recently in the last few years, I think, and off to the races with, and this is definitely an AI adjacent name because with their computer storage, they provide
So I think
storage devices.
Ed Seikoto would say this has the property of going up.
A bit.
I have some good Ed stories. But yes, he would say something like that. Yeah.
Mike, how did this get into your universe? So is it just that you scan stocks and then you jump on board anything that's materially moving, or was it part of your defined portfolio? How did SanDisk get onto your radar?
Yeah, and this is Jerry doesn't like it. He's going to shake his head. He's going to throw food at me. Doesn't like it because it's technically not. It's not fixed. It's not a fixed portfolio. It's a fixed rule that selects. It's a fixed selection rule. So it selects based on recent performance. Yes. And SanDisk has been number one for, it has to be 6 months or so now. I have to look, but I've been in it a while, and it's just one of those things where, and we'll get it. This all goes into the MythBusters too that we'll get to, but the stock is one thing, the company's something else, and our job is to trade price, trade the stock, trade the futures market, trade the currency, and on down the list. So this is what we do.
Hang on, you're telling me you're not looking at the price earnings here at 1,600?
I'm sure there are a great bunch of guys, great bunch of people running this company. I'm sure they do great things, but you know what? I heard someone else say it might have been Ed. He said, "If you're a trend follower, if you sell it higher than you bought it." So everyone needs a trend to make money, and this has been the strongest trend of them all recently. So thank you for your service, and I'm going to stick with you as long as you keep at it. And guess what? When you don't, you're out, and that's it.
Okay. Have you scaled? I just want to ask one question. Have you scaled back on this position, or does it effectively just grow and grow and grow?
Don't insult me. Absolutely not.
Oh wow, that would have been embarrassing since Rich has spent 30 minutes telling us what a great classic trend follower he is.
Okay, JP, I'd like to press you here, JP. Okay, so what? I gather what Mike's doing is effectively it's a watch list over the stock market, and he's jumping onto material moves. So where do you have your issue with that? Why do you think it's got to be a defined portfolio as opposed to, say, a watch list that you step in when you see these material moves occur? What do you see the issue is?
Oh, the issue is number one. I was going to ask Mike, no one does this. with the rest of their portfolio. There's no CTA. Well, maybe they do, but why not do it for the whole portfolio? Why don't we all just start doing it for the whole portfolio? Why stocks? Right? That's not a good. You're not going to have a good answer. Let me just tell you, there is no good answer. That would be easy. Don't give me anything, because that's just too easy. So that's a problem, but that's fine. We all have to make these compromises, I suppose. But it's really just a case where I think you run into some sample size issues. You run into an issue where, like, everyone knows that if ScanDisk is in your portfolio and you don't take the breakout, that's a mistake, right? And if but then if you sort of say, well, it'll be in my portfolio if it ranks higher, and then it doesn't rank higher, so you don't buy it, and then it has a big trend anyway. So I just think it's too many rules and parameters, and sample size is an issue. And with trend following, you've got to have a fixed universe of markets to play in because of that very issue. If for whatever filtering device you use, you don't take every trade in the British pound or every trade in ScanDisk, then I think that's a problem. The math gods don't care if you have a fancy filter and or you just, through a lack of discipline, refuse to do the trade. You didn't do the trade. It doesn't matter why you didn't do it. You're not taking all the trades as you would, as I thought we all assumed that you should do. What is a good excuse you've ever heard from any of us, or really anybody, for not taking the cocoa trade? The only good excuse is it's not in my portfolio. But there is no other good excuse. If it's in your portfolio, you got to take it. And having a portfolio where you're filtering in and out all the time is not classic trend following.
Correct. That's no, I want to clarify. This is not what I do in my fund, in my futures fund. So this has been a separate strategy that I wanted to make something more classical, like an index, but better. Okay, like what's better? Like, higher return, lower drawdown. How can I do that? So that's when I got down the path of this, watching the same components of the S&P. So it watches S&P components, and then it runs the calc periodically, and then finds, it naturally finds these strong stocks, and then just takes some equal weight positions. Okay. Simple as that. So this is not what I do in the fund. That's different. That's different. Yeah.
Yeah, right. I would just say that it's not really like something I really care about very much. It's just, it's none of my business really, but just from a theoretical point of view, it is kind of something fun to argue about. I do think one thing that's kind of interesting over my long career, I wanted to trade stocks maybe from day one. Once I sort of heard from Richard Dennis, like, really diversification is really one of the main things. And so I said, well, if you really want to press the diversification, you've got to get into stocks. You got to get into single stocks. We traded single stock futures for a long time. They're coming back this summer. But I just remember people asking me, like, well, how are you going to trade these things? There's so much more information versus commodities or interest rates or currencies. And I'm like, I'm going to trade in the same way, just the same breakouts, the same systems. What? This is crazy. And this comes from CTA trend followers. And so it's just like there's a part of CTA trend, not mine, everyone else, I'm innocent, that their brain just cannot handle when it comes to stocks, that you're going to treat them the exact same way. Number one, you're going to trade them. You don't trade the dollar index only. You don't trade a commodity index only. You trade everything inside the commodity index, everything inside the dollar index, but not stocks. Oh no. Why? We don't know. Not really sure. But if we are going to trade stocks, we're not going to use the same methodology. What the hell?
Yeah,
That's very surprising coming from other CTAs. But I guess that speaks, I think, to the bias and the human condition we all have. Is like people probably have some preconceived feelings and beliefs about stocks, and they form attachments with them. They interact with their products, and they think they think there's something special. And I don't know.
Well, we've been contaminated over the years by watching, people talk about stocks, and then we get into trend following, and it's futures. And then you just can't shake this bad information and bad philosophy you have about stocks are done one way and fixed income, FX, and commodities are done another way. I was on the phone once with this guy. He was a potential client, or he was a client, and I was explaining to him how we traded, and I told him, we trade single stocks futures as well, and we trade them with the same systems, the same trend following. He got so mad at me. I was attacking his MBA degree. It cannot be that simple. You cannot do this because you're calling into question. You're insulting everybody on Wall Street who has to look at things fundamentally or technically or in a much more complicated way. No.
If you guys remember the series that Niels had on Top Traders Unplugged, where he interviewed all of the CTAs. Jerry, you were in there with Chesapeake. Now, when you go through that series and you listen to each of those episodes, the only one I heard that was advocating cutting losses short and letting profits run was Jerry in that entire series. The other guys are not using those heuristics. They're using complicated correlations, all of these things. They're not doing what we're doing. So, I see this significant difference between the mob in what they're doing. I think that's what Jerry's sort of describing here.
Yes. Well, it's a sad situation where you take this wonderful strategy, you have playing for outlier trades, hunting outliers, and it's become the smart guys got involved and it became maximizing Sharp. Getting rid of the outliers were a problem. I've heard this before too. I was totally shocked by it. We need to get rid of these outliers. They play havoc, with our portfolio. We have too much volatility, so it's kind of sad. It's kind of like your family name going away. You had all you had was a bunch of daughters, no sons. Your family name, the Parker name, is going away. Unless something dramatic happens here. And I feel like that's the same thing happening to Classic Trend. It's going away. With 5 people,
we're still here, Jerry. We're still here.
It's not going to be around much longer.
That's fine. That's punk rock. It's countercultural. That's fine. We're in the village. We're not in Midtown. We're in the village. We're the cool kids downtown. You got to go find us. We don't have the big office, the big shiny stuff. No.
Yeah. We'll let the other kids play with us if they're lucky, Adam, you brought some charts along. Give us a rundown.
Look, I do, and I think it sort of ties into this whole SanDisk, AI, RAM thematic. And so obviously we've seen that thematic turn up in the US indices, and then the big Nvidia, and then SanDisk is clearly the poster child for this trade with the 40 bagger. Most people will be lucky if they ever get a 10 bagger in their life. And Mike, there you are with a 40 bagger on the chart. And so on that same sort of thematic, I have got these charts here because we are in these positions as we speak. And so we've got the Taiwan index. Obviously, they're doing some chips there. The high-tech stuff is in Taiwan still to this day. And you see there 100% return over the trailing 12 months. It's funny here, we're like 100%. Oh, it's just 100% return for the 12 months. But obviously that's a fantastic run, nothing like SanDisk. And then a similar sort of story in, the Japanese market's a bit less because I think that's a 50% return. But then we get the Korean index, which has a very heavy weighting to Samsung, which is another one of these RAM manufacturers. And here we go. It's gone like from 2,000 to 6,000. And so you've got a 300% return in a stock index in 12 months, and it still looks strong, even of last week. And I think this is probably the best performing equity index that we trade because we don't do single stocks at the moment. So if that changes in the
We've
future,
still got our trainer wheels on, Jerry.
Yeah, we've still got our trainer wheels on. We're in the futures for a few reasons. We like the liquidity and we like the low cost of the brokerage as a percentage of the notional. So I think that plays to our advantage. I agree. There are less chances for outliers because these indices effectively mute. The index can't have a takeover in the sense of a stock. You could be in a stock and then there could be a takeover, right? So the index can't be taken over in that sense, so it shouldn't gap up 20 or 30 or 50% or whatever in a day, right? Whereas SanDisk, somebody could buy it and they could pay twice the price if they wanted to, right? And there's nothing to stop that happening.
Yeah. Or the downside, right? It gets cratered. It's just the trade-offs. Yeah.
But conversely, there could be, and I'm not talking about an individual stock now, so we're just talking in generalities. A stock can have a downgrade, a stock can have an accounting scandal. Some of those things can actually come to market with very little trend or for trading. So if something is very tightly held, like a corporate action or a downgrade or something, or a regulatory action, it can actually come as a surprise to the market. And so you get that there are those pros and cons, and then there's some liquidity and technical matters. So if you have a trading desk, it might be harder to execute across 400 instruments, including a whole lot of stocks, as opposed to herding the capital into like 100 liquid futures. But that's just our perspective. And who knows, maybe we will pick up stocks, Rich.
All right. Well, gents, I think that's what's moved the needle. So now we're going to move on to the segment I've been looking forward to most today. And I suspect our listeners are going to feel the same way once we get into it. Mike, I want to take you right back to the beginning of your journey. But before I do, I just want to say something to our listeners. One of the things that makes Turtle Talk different from most financial podcasts is that we're not really interested in the polished, sanitized version of someone's story. We want the real thing. The moments of doubt, the hard decisions, the lessons learned along the painful way. And I've got a feeling that Mike's story has got that in abundance. So let's start there. So, Mike, first question. You launched Melissinos Trading in 2011. And from what I understand, those early years were not smooth sailing. You started with, I believe, 3 limited partners. You were building something from scratch in the aftermath of the global financial crisis. And trend following itself is going through one of its most difficult periods. So most people during that regime would have folded. Most people would have looked at the drawdowns, looked at the investor conversations, looked at the difficulty of raising capital for a strategy that was out of favour and walked away. But what kept you on track? What was the thing, the belief, the conviction, or the stubbornness that made you stay the course when it would have been so much easier to quit?
I think it was all the work I did and all the confidence I had in it, like, okay, I know this happens, and um, this is new, but of course, think new things are going to happen. And yes, this is not fun, but you know what? Cash flow is positive, expenses are down. Um, when I started, it was my girlfriend at the time was now my wife for 11 years now. She was rock solid. That is a very uh, underrated ace up the sleeve, is to have that support from your closest people. Um, so I don't know. I think I just had the confidence, like, okay, well, of course trends are going to happen. We just got some. Had I been trading through the global financial crisis, um, bad luck, bad time. I didn't. I just kind of came into the work world at that point. But that would have been a great time. And then, okay, naturally, maybe we're now going into some sort of lull. And sure, that lull at the time, extend a little further than I would have liked. And don't get me wrong, I've broken things in my room and house before, during that period. I still have a moleskin, and I keep them over the years. I keep one per year. So I have one that has a iPhone imprint in it because I threw it down so hard one day when it was really, I was getting carried away with my expectations. Like, okay, all right, you start to get a glimpse of some new trends coming. And then here we go. And here we don't go. And I was like, and I had it in that moment. And so I had a few of those sort of thing, but I never, and I believe Jerry has said this too, where I'm often, pissed or frustrated, but never confused about what to do. This is the right thing to do, is to keep doing the system. That is it. If you have that, you have it. Now, that's where the
And we're
work
calling
is.
Jerry a lot during this time, saying Jerry, getting a bit of sort of mentorship and alignment with Jerry over this period of time. Was he keeping you on track?
We had our first coffee in early 2016, right after I got married, and
Okay.
that I don't think so. I don't think I bothered him too much about that stuff. Maybe I did, but maybe when we started working together more, intimately, years later, a few years after that, we'd be, we would, share our displeasure with the ups and downs of it all. I remember during COVID too. That was I was on vacation in Mexico City, and I'm at breakfast, and Jerry calls me. He goes, "This is not a virus. This is something else going on." The markets were crashing and stuff, and I said, "I don't know. This is I'm getting killed. I'm watching oil go down 30% in a day. Remember that? I forget. I think it was a Sunday night.
Oh, mate, I remember that. Yeah.
Yeah,
Are you talking
just,
about this this is this
no.
down that starts in 21? Is this around about
No,
that time?
this was
your equity curve.
this was, I believe, March. This was early March 2020. Yeah, when oil got destroyed in one day. I forget what the reason was and all that. And then that was a month or two before it went negative. So this was kind of the really early COVID days where this is talk
At least
about a
that put us
virus, and now
short,
it's
if I remember, Mike. That put
not
us
at that
short,
point.
thank
Not at
God.
that point. I was still
Okay.
long at that point, getting crushed. But but before that, it was and this those early years were okay for me. And it was after 2014 or 15, 16, 17, 18, which were, oh man, an odyssey. It felt just, oh man, so long, dark times, lot of rage. But, you know, you learn how to be calm, you learn how to be disciplined in the face of all that, and that's the one thing I never did. I never broke it. I just kept with it. Okay, this is going to turn. I know it, but just don't go out of business. Don't crack up. But I was very fortunate to have very good investors as well, because I didn't, and I would catch myself because it was my hopeful part of me talking, which was to sell the performance. And I think it's better to sell, well, this is what we do here and this is why we do it, and here's the performance, and then here's kind of if you want to go back further and look at other firms and look at simulations and all that, but this is how it works, this is what we do. So I wasn't getting bombarded with yelling clients all the time. That wasn't happening. So that was also, I think, a huge component of being able to stick with anything, no matter what you choose, no matter what system you go with. Okay, well, you picked it, and now here we go. Now you got to do it. Now, if you're not getting pressure at home, pressure internally from yourself, and pressure from your investors or employees and all those things, if you could just operate and just keep doing it, that is a huge advantage. I believe I had those advantages. My internal was my biggest hurdle, me, not anyone else. So I never
Is your
broke.
baseball experience coming through? What kept you on
No,
course?
I was born.
Baseball.
Yeah, I was born this way, though. Me and Jerry, we do fantasy hockey. We have $150 on the line. We treat it like it's a Super Bowl. We're totally crazy. This is just who we are. Now that's all fine. Getting riled up and all of that is okay, as long as you don't do stupid things and you don't flip flop and get new ideas and change it around. And oh boy, because all you want to do is win consistently all the time. That saying those things to me, being okay with, all right, we're in a losing streak, but if that becomes I'm losing, if that becomes I'm a loser, that's different now. You got to be careful now, because now you can go to the dark side of, you could lose your purpose and lose you lose your nerve fast if you start talking to yourself like that. And people do, I think, during drawdowns, and like, well, what am I doing here for you? Your stocks are killing it. I'm a drag, and here we are in year 4 of this, year 3 of this, in a 50% drawdown. Like, oh, like if the performance is what's going to be swinging you like that, you better get a good therapist. You better get a training tribe or something, because you're not going to be able to hang on. You're going to be your own worst enemy, and I think take yourself down. So I was fortunate to,
Did you? Sorry to interrupt there, Mike. But did you reach out to people in that drawdown? What did you do to cope with a drawdown?
Yeah, and last year was at the bottom of my worst one. I was, I think, a little over 50, but I still can't believe it. I still say it to this day. No one called me. No one. I have about 50 investors. Not one called, except my dad, who's like me, and who's also in the fantasy hockey league, who's also a lunatic. So like, we just want to win. We don't want to win all the time, and but that during that time, I was just so mad. I was so upset, because I may have said before, I don't know if before we were recording yet, but that was early 25 was the time that I settled at my new heat level of my system. I wanted to be a higher heat, higher octane, more old school, go for bigger returns sort of thing. Before that, it was kind of middle of the road, which speaks to my indecision and my own personal journey. Like, okay, you're not where you want to be. This is where you should be. This is who you are, Mike. You're a more success seeker, not like, let's lay back and let's be a nice diversifier for you. No, let's kick ass. Let's go. So that getting to that point and then getting rocked with the tariffs was like, that would really annoyed me. But no one called. And then, again, this has nothing to do with the system. This has nothing to do with the math, the rules, anything like that. You know what helps? Seeing Jerry for coffee during that time. Just talking. Just like, here we are. Okay, let's vent it out. Let's lick our wounds. And then also too, around that same time is when I called Ed Sakota. I had been in touch with him over the years, as much as you can with an 80-year-old man who lives across the country. I'm not buddies with him, but had a good rapport with him over the years. So I called him too, and we talked for an hour and a half, and he was like, "Oh well, it sounds like you got the trend following blues. That's all. This is just how it is." He's been there, and but he was telling me too, refer back to your tribe. And I had spent some time in the tribe before I started the business, so 2010, because I was nervous about starting. Can I do this? Self-doubt, all those things. So I was getting over that hurdle that the tribe really helped me. And I still have investors from the tribe, they saw me like kind of go from no firm to a firm, and then they invested, and they're still invested. So that's almost 15 years, over 15 years. And then it went back and did it a couple times over the years too. And 2018 was a period, actually, funny enough, right before me and Jerry started working together. And then I would call my session with Ed on the phone, and then my in-person visit with him in Texas in the fall around October, last October, as a tribe session, because he's right to it. There's no fluff with that man.
Is he still trading? Is he still trading his own?
This is a great question. Great question, because he pulled out his phone to look at the markets. I think he pulled up FinViz or something, looking. And I said, "Oh, are you still trading?" He goes, "Well, I'm not trading right now. I have positions on." I go, "Yeah, you know what I mean. You know what I mean." But that's how he is. He's very stickler with the language. So he does that on purpose to, I think, really make you look inward and like make sure you know what you're saying. And like, yeah, takes it a little far sometimes, which he admits. He's like, I take it, a little too seriously sometimes. But yeah, that's he is trading. He does take positions from time to time. Yes, maybe that's the better way to say it. Takes positions from time to time. Yeah.
Jerry, you've gone through these hard periods over the course of your life. Have there been any moments where your mind has tried to hack your process? How do you deal with that?
Oh, what do you mean by that?
So the mind there is, take for instance the April that was the Liberation Day event last year. This is what was going through my mind at that particular point in time. Those volatile whipsaws of Taco were so materially large that each time it flipped, I actually got engaged in a position on the other side. So the problem with that, I thought to myself, God, if this continues, I'm going to go to oblivion. And I thought, this was the perfect anti-environment for my trend-following models, that I thought, my goodness me, here's our weak spot. And I thought, if this extends, I'm doomed. That was my brain telling me, trying to hack my process. Has that happened to you? Like psychologically, how do you deal with these really bad times? How do you stop your brain interfering with your process?
Oh, well, I think it takes time and it takes practice, and you have to make those mistakes. There's been times where I was at fault, so that was particularly frustrating. There's times where it's not my fault. The markets are just poor. Sometimes I haven't followed my rules like I should have. Sometimes I was trading too large, and a big drawdown turned into a drawdown that was way too big. So, yeah, I think it's just something, you have to sort of live through. One of the things Mike didn't bring up, I think he told me once that going back to Wall Street and doing something other than trend following was just not possible. It was, even in periods where it's not fun, it's still better than where he came from. And I think that's how I feel too. I remember during the Turtle class, Rich said something like, I've heard real jobs are not fun, and I've never had a real job, and I don't want to have a real job. But if you guys don't follow my rules, you're going to have a real job again. So I made it my life's objective never to have a real job. And I think to a large degree, I was able to pull that off because there is real jobs to be done in a CTA firm. You just can get other people to do it. And I can feel that I have the ability to think about how to make things better and do research and philosophize on how it all should work.
You know how you were saying you thought at one stage you were trading too large. So this is where, Mike, correct me if I'm wrong, but Ed Sakota would say something like, know when to break the rules. So was that a case, Jerry, of you saying, right, I had this process, I was trading too large. Was there something in you that said, right, I need to change my rules, or did you continue with the process?
I was just trading too large. And the definition of trading too large is losing too much money, your own money, or losing all your clients. So we lost a lot of clients.
And you adjusted from that? You adjusted your stance?
Of course, we had to adjust from that and trade smaller. We weren't trading we weren't trading. Our adjustment wasn't to trade really small. It was just to trade a lot smaller than maybe we were trying to make 40% a year. And so we said, let's make it 15 or 20. So we were way, we were way out of what we should have been doing. It was just not a good situation. I remember being very confused about what I was supposed to do. Even I got very confused, like years into my career, like in the 2000s, like just being very confused. I have no clue what's going on here. I don't know why. I have no confidence, and I'm very confused. I got out of that funk probably because I wasn't following my system, and my system was polluted with a lot of bad rules. Following rules used to be something that you could just say, yeah, just follow your rules. Now, with computers, you can come up with so many bad rules that following the rules is really not a good thing any longer. And so you've got to be careful making your bottom line, hey, we just follow the rules. Ipso facto, we're not to be blamed. No, because let me see those rules. I don't like those rules. And I've been there where we had
line. Some people.
I don't think the line is that fine. It wasn't always fine in my career. I was making some really dumbass moves, and the rules were really bad. It wasn't a fine line at all. So.
Mike, what are your thoughts there? Do you doggedly persist your rules, or are you prepared to change them? What's that relationship there with you?
No, I love them and I stick with them. And the exact rules I had day one were the same but shorter term, and I traded less markets because I had a lot less capital, and I couldn't trade as long term as I could. Given things, given the markets a little bit more room to wiggle around. So I always wanted to get to the system that I have today, that I've had for a while. But it takes time. You got to do the best you can with the capital that you have, and maybe the more work you do and things like that, and you can start to look at other markets. But no, I don't have any reason right now to change them. If I say, hey, I believe it for myself too, with investing very heavily in my own strategy. So maybe one day where it becomes a huge number and a uncomfortable number because I traded a high heat, maybe I don't want that swinging around as much. So maybe I believe taking some of my personal more off, making it a lower percentage, that sort of thing. But and maybe run into a situation way down the line, who knows, where we do well and like investors feel the same way and they want to take some off. But I don't foresee myself, taking the heat level down, introducing new strategies to smooth it. No. I don't see it happening. I like it. I like the way it is, and I know when you start changing things around, you got to give it time to kind of settle in and see how that change affects the future. Because those sometimes those subtle things can make a big difference. I add a new market in, take a one out. Silly things like that. Oh well, we're gonna dial up the heat and be at this now, like I just did. Oh well, that makes a difference now, doesn't it? Because you run into a drawdown, it might have been half the size. Now it's double that. Like that's a real thing. So like all that matters, and I think you got to be careful about touching it too much. Really
Jerry,
have
are
a
you
reason.
more fluid than that?
Why.
No, I mean, we do research and we change some of the look back periods every 2 or 3 years. We've been getting a little bit longer term, but we traded basically the same type of strategy, the same system, same philosophy since early 2000s. But we have sort of gotten a little bit longer term. I think it's better for the stocks that we trade to be a little bit longer term than we have been. But I'm not above making improvements and trying to make changes. You just have to identify what is the cause here. Not long ago, AQR wrote a paper, other people have written a paper trying to figure out what was wrong with CTAs, and the conclusion was there wasn't enough outlier trades. Okay, I think some of our funds trade 50% equities. I think there's thousands of stocks. They kind of deserve more of, you can probably justify up to 50% or even more for diversification purposes. And they've been having great trends. So I'm looking around to try to do things so we don't go through these periods again. And I think that's probably a good idea to include more stocks and emphasize stocks and get more things into the portfolio. But I'm not really one to tinker too much with our strategy. It doesn't need to be tinkered with. The performance is maintained sort of consistency over time. But I do see longer term strategies getting rewarded more than some of our shorter term strategies. So it makes subtle shifts like that.
Adam, any tinkering, or do you stick firm to the system?
I think the system has been relatively or quite stable since the fund launch, and then prior to that, there was a lot of tinkering and problems, basically. So I actually started like back in the day with 50% trend following, 50% discretion, and that predates the current track record, and it didn't work out. It didn't work out at all. And so I just took the decision to say, basically focus on your strengths, and the strengths was the quantitative approach. So like we know there are these trends. We know people are making money out of trends. Can we write an algorithm that is a top quartile performer in those trending markets? And then as we raised more money, then we added more markets, and so we've had more markets added to the system. But the actual underlying algorithm or philosophy that underpins it.
What are we up to now? 90? Is it 90?
Yeah, it's almost 100.
Okay,
it's almost 100, and we're always looking for liquid futures to add.
Mike, what are you up to?
Yeah, about 100 as well.
With your diversification, about 100? And JP, you're in the 300 range.
No.
What are you?
Maybe 200, maybe.
Okay, yeah. Yeah, that's pretty impressive. Yeah. All right, look, now, Mike, we're going to have to step through this a bit quickly because we're running out of time, but I just want to take you back in time. I believe you're at Bear Stearns. Okay, so from your point in Bear Stearns, what was it that pointed you towards the direction of classic trend following? Give us a bit of your background.
It started before that when I was in public accounting, and after the busy season, auditing hedge funds, there's nothing to do for 4 months. And so I'm spending the whole summer of 2007 sitting around in Midtown Manhattan office looking for things to do. And I'm walking around the office and say, hey, anything to do for me? Come on. And there was nothing to do. So I started reading. And then that's when I believe the Fed reduced rates unexpectedly that summer. I believe is when something's going on in the market, sort of thing. It's when like the subprime really started to get going, and somehow came across Trend Following and Mike Covell's books, and then all from there. And then I started tracking the firm's performance all the time. John Henry's still around. A lot of the more turtle guys were around, still trading at that time. And
is there something in this accounting mindset, Mike? Like, you're an accountant.
We're just we're organized.
I'm an accountant. What is it?
We like rules, we like order, we like organization, and I think things like that. Less artistry. We want the answer. What's the answer? Sort of thing. And there is a right number here, so that so maybe that we could all take a personality test, and maybe we'll get all the same personalities. We should do that.
Maybe we also all know the tricks of window dressing. So when we're looking at fund management performance, we can see who's window dressing their returns and who's doing the real thing.
Yeah. So about that time, like summer 2007 into the fall, getting more interested in the markets and what's this trend following thing. But then one of my best friends from growing up worked at Bear Stearns, and we were talking. He's like, I get you an interview if you want. I'm like, okay, because that's what I want to do now. Yeah, I want that path. And this accounting is not for me. And so we did that, and I was lucky enough to get that job in the fall of 2007. And then obviously time ticking by, markets starting to unravel, and I'm still tracking guys like Jerry, Salem Abraham, Dunn, John Henry, all down the line, and just trying to get. I'm getting more comfortable. Like, okay, now I'm starting to understand. And it's one thing to read about maybe prior performance and looking at the monthlies. Like, I wasn't around. I don't really know what's going on. But when you start to see it, and then you're real time, and then you start to put this performance together with, okay, now I'm knowing what's going on in the world, what markets are moving. Okay, now it's starting to make sense to me now. And then Bear goes out of business, and you're like,
yeah, I remember that.
Okay, because also too, I've played baseball, a long time, and that's who I thought I was, what I am as a baseball player, and that's all I am. And all these other people here, I'm lucky to be here in this building with these smarter than me people. So I didn't have a lot of confidence in that area. And then when they go out of business, you start to rethink your whole belief system there. So seeing trend work at that time, early 2008, and then throughout 2008, when the fall hit and Lehman, AIG, all those things, you think, okay, maybe I'm not so dumb. Maybe they're not so smart. What am I missing here? All right, I could do this. I got to figure this out. I could do this. So all those kind of light bulbs
flying during that period where Bear Stearns was going out of business. You're looking over
and
to
then
Jerry, and he was grinning.
Yeah. And I have these, the innate competitor in me was, I'm sitting here losing. I'm sitting here inside the castle walls, burning. It's burning down here. This isn't going to happen to me in 30 years. No way. No way this is happening to me. So I remember going around telling people, the traders I worked with and the people in the research department and the guys on my team. And I'm like, you heard about this? You know what this is? Let me tell you about it. And everyone was just like, no. And they didn't really care. And I'm like, they don't care. The firm's gone. What? How come you don't care? What do you care about? And that was very enlightening too, which was people are so dug into their beliefs, even if they're in the ground getting killed. Like, but this is still, we just got unlucky this time or something. It's like, no. If you behave this way, you put yourself at risk of this, over leverage, not cutting losses, disrespecting the trend, and being all in on one area, and for many people there at Bear, at least in the stock, and then sadly again at Lehman, and then other areas, other stocks, I guess too, got crushed. But it's just to see it with your own eyes during such a painful time for so many people. But then to feel like, here's the golden ticket, fellas. We can fix this. Don't you want to fix this? I understand this is not like the magic pill where it's going to solve everything. There's going to be losses, of course. Just look there. But you know what? They're honest about it. Yeah? They're honest about it. And they say, oh, yeah, we know we're going to lose. We know things go up and down. We know. So we're going to protect our ass. And we're not going to get ourselves in a jam where we're going to be out of business like that. And that's what happened. And it's lurking out there for you if you're doing those wrong things, especially to that degree with the leverage and never exiting and doubling down in your beliefs, then you're at risk of this, whether you realize it or not. And it's waiting for you, and you just hope it doesn't happen on your watch. But you live long enough, it's probably gonna. So that was enough for me to to see it with my own eyes and to see a path out, and then being able to kind of return to who I was. I'm not the accountant. I'm not the sitting on the sidelines keeping score. I'm in the game. I'm supposed to be in the game. That's who I am. So it was like it was a lot of personal growth, and then a lot of learning during that time. And luckily I was young enough. I was 23, 24, where I didn't have any money to lose and, lose my nest egg. I didn't have any stock, at Bear or really any investments around that time because I had just started working. So, this was it. All right, this is it. Now, how am I going to do it? Now I got to figure it out how to do it. And, so.
Perfect. Well, look, we've covered a lot. We've covered your Ed Secota a bit, your diversification, your early life. Now, before I go and pass it over to Jerry and Adam to perhaps ask you a couple of questions that they want to ask, I just want to talk about your recent performance because it's absolutely stunning. You are hitting it out of the ballpark at the moment. So, obviously, this is where the process is paying for itself. All of that grief and second guessing and everything that's occurred over that time is now paying out. So, how are you feeling at the moment with your performance, and what's driving it, and is it all worth it?
It's a shock. Not to say a shocking feeling, but it's a feeling I believe that I think I've always wanted to get to, no matter what the performance was I feel nothing. I feel nothing.
Okay.
I'm feeling
blank.
Okay. I'm doing the system. This is what it's supposed to do. Okay. Thank you. I understand I'm not in control of the markets, but doing the system to the best of my ability. Every I is dotted, every T is crossed, and I don't miss anything. Everything is nailed down to the last decimal point, and I feel good about it. And I trust that I do that, it'll be fine. So when last year was happening, even though I was pissed, and I was, I'm still growing. I'm still growing, Richard. I haven't solved it all
So
yet.
you can get angry at yourself, but you won't.
Yeah.
You won't reward yourself. You like getting angry at yourself, but you won't reward yourself.
The feelings are not the problem. It's the response to the feelings that can be the problem. So I'm very conscious of those things. So last year while I was upset, okay, we were getting crushed, but all right. And then sure enough, right, you keep doing it. Good trends roll around. There you are with them, and there you are, riding and benefiting through the through the depths of the drawdown, and then we got some good trends, and now we're doing all right. Great. That's how it's supposed to be. And then hopefully hopefully we get more great trends. I don't want to go, and do personal growth exercises every year where I'm getting killed, and then I gotta, at least I'm growing. Like, no. I want to make a lot of money. Hopefully we're on the path of some more easy, smooth trends. Coming our way over the coming years here, and that'd be lovely.
Well,
but
if you're not prepared to reward yourself, Mike, we'll commend you. That's a great performance.
All right.
Absolutely fantastic.
Yeah, I have tough.
So
you
got to take it. We're giving it to you. But
okay, thank you.
Jerry, Adam, any questions you want to ask Mike?
Yeah, I could go. Is it true that you started trading just 11 markets, and
yes.
then and if that's true, as you scale to 100 or 100 plus, what are the statistical trade-offs you look at when making that decision?
Well, I think all the trade-offs I've made have been positive. I think about it like, okay, what if I started in 24 or no, 23 maybe, because that's when cocoa started to break out. At least I think it was early 24, and it was still intact. The trend, I still had the position for like the most of 23, but the profits really didn't take off until 24. So I think about that like, well, what if I didn't choose cocoa then? And if I started in 23 and cocoa wasn't in the mix, and it wasn't in the first 11 mix that I chose in 2011, I mean, what would I have? Imagine the personal growth I would have been going through then. Like, oh my God, why am I not in this thing? This thing's insane.
Personal growth.
Yeah. So I feel comfortable at a market universe now that is very widespread. It's all the markets are liquid, and it's practical. I could actually execute them without it being impractical. Like, I don't know, as a one-man shop that I could trade 3, 4, 500 instruments like Jerry does. He needs a team and things like that, and that all matters too. So yeah, I remember exchanging an email with Jerry. It might have been around that 2018. So like some of those dark years too, where I was mad that I should have been trading silver as well as gold, because gold was in the first 11, but silver wasn't. And I remember being pissed about that because I thought, this is when I'm just naive and talking, and I just want to win all the time sort of mentality. And I said, yeah, I should have had silver, and then I should have had gold as well, because silver trended earlier in 2011 before gold did. And I was like, I should have had them both. And Jerry was like, no, relax. You're doing the best you can with the assets you had. You got to make a decision. And you can't beat yourself up and try to have everything all the time. So this is it's like how invaluable that is. It doesn't do anything. It just calms you down, and it keeps you just doing the thing. and that is what's so important, like, so yeah, no, long-winded answer. I'm happy I don't have only U.S. market exposure. I'm all over the place now, South Africa and Australia and Far East and everything like that. So I would love to get those China commodities, boy, but they're making it tough for us. Making it tough for us to get it. But man, I really hope one day we can get those. Again, with like a reasonable cost and the money's safe and things like that. I'm not comfortable putting it in China right now.
Yeah, good one.
Yeah.
Jerry, anything you want to throw in to the conversation with Mike?
Well, I've encouraged you, and you've stayed true to your business model with your fund, and taking good care of your clients, knowing your clients, and then I think I also encouraged you. I mean, I'm not saying I was the one who, it wasn't my idea, and I don't think it was my idea necessarily, but I definitely have encouraged you for step number 2, which is to trade aggressively.
Yes.
Maybe not up to the speed of Mulvaney or whatever. And so, and right before you did that, you shared with me, we talked about how you felt like that would be an okay thing for you to do from a back test point of view. And I 1,000% agreed. I understood it. And, when you use closed trade equity, and you can trade pretty aggressive, historically, that has been possible. Now, the implementation and losing 50% or whatever you lost in that 1 month, but I'm not sure about all that. But still, though, the big question is, how are you going to raise more money? It's such a low profile, and even with good performance. And what is your strategy? And what do you think? Are you going to be happy with a little bit of money, or
I'm going to start an ETF.
200?
No, I'm joking. I couldn't pass that joke up. I couldn't. I had to.
Yeah, it's good.
I wouldn't do it. No. I don't know. I keep trying to. I feel I have 2 jobs: to do the system and just get the word out, and just tell people, like, here's what we do. Here's where it could. Here's some benefits. Here's some. Trade-offs, how it's different than maybe what your current investments are, things like that, and just see who's interested. But trying to pull teeth and try to convert everybody, no, I'm not doing that. So I'm just trying to be like a child, like my son. And he just, like, these little kids too, they teach you so much. Like, they just do their thing and they don't give a shit. And they just do it. And, like, all right. And you know what happens? People tend to flock over to them because they got a buzz around them. They got like a vibe, and as long as they have something good, obviously, right? So I feel like I do. I feel like we all do. We have something good here. So why are we hedging the way we talk, and why are we not like, hey man, this is what we do here. We're not gonna like change it because you're unhappy with it. If you want something else, down the road they got something for you, no problem. But so I feel like that's been a mistake, and that's more, like, again, more personal growth, more trading tribe, more early life Catholic school trauma, which is, this shyness, this, I don't want to be embarrassed, I don't want to look stupid, and I've had some of those experiences early in my life where I don't want to feel that. Well, okay, then you won't feel it. But guess what? No one's going to know what you're up to. No one's going to know what you're doing because you're not talking. You're not okay with rejection. You're not okay with, like, yeah, but why would I do this? Your performance sucks. Yeah. What's that feel like? Yeah. But you're like, okay. Yeah. All right. But, like, again, I think you're forgetting maybe the thing that you're feeling so strong about, Mr. Stock Boy, is that they've gone through shit periods too. you've just forgot, and we haven't hit one recently. So, and that's another thing. Jerry always stuck with me too. Is like, but not lately. It's not. It's like a phase, not a fact. This is lately. So again, don't get too high, too low, because markets have a way of bringing you down, and then giving you hope again and keeping you. But so you gotta understand that, and then when you're talking to people, and again, if it's all about performance all the time, and understand that you have a golden age where it's stock strategies and things adjacent to that, private equity, right? Well, they don't even have to mark the fucking markets. They just come up with anything they want. Like, how easy that is to sell? That's amazing, right? Because it's all performance, and people will eat it up. But be careful. Be careful, because the smart people, the people who've been around, and people who've seen some stuff and been hurt and seen people get hurt, is like, yeah, well, what are you doing? Why do you do it that way? And what are the risks here? And things like that. And they go into the process and philosophy and the belief system behind what you possess, and then your product is a direct result of those things. But if all you're talking about is surface level performance, best of luck to you, because you're going to have people coming and going. It's going to be chaos, and hopefully you just stick. You get a long enough. You get a long enough run where people would stick with you long enough, where you can all do well. But what's the reason? Like, I'm not swayed of changing things. What's the reason Jerry's not? And like other guys, like Dunn,
because really we're comfortable. That's what it is. You have your holidays in the French Alps.
You know how much of
Jerry
it
has his holidays in his ice castle in Sweden. We have our holidays in Malaysia. It's a good lifestyle. What a great lifestyle. That's a huge edge. Do we need the AUM?
So yeah, but like I don't have any visions of running a massive firm with tons of people. It doesn't speak to me too much, so I can keep it tight, and we can ramp it up, and hopefully get some good markets, and make a ton of money, and it will be all right. And run lean where I can know everybody too. That's important to me too.
Get those Mulvaney returns, Mike, and then you're there.
Yeah. Well, that boy is on one right now. He is on some sort of heater. Man. My God.
April, what was he? 117 or something % year to date?
Yeah.
January, March, April. Pretty impressive.
Yeah.
All right, guys. Well, look, I think we're going to have to probably curtail this podcast now. We've been running for about close to 2 hours. We haven't got through it, which means, Mike, we're going to have to get you back on to complete this thing, because we've got a couple of Mythbusters, and I know there's stuff Jerry wants to talk about and stuff. So, look, what we'll do is we'll wrap up now. Mike, thanks very much for coming along. It's been eye-opening, and we love having you on board here. It's the classic guys speaking frankly, which we all love. So, Jerry, thank you very much for participating today. And Adam, of course, anything you guys want to say before we wrap up and say goodbye?
Go Knicks.
No. Go Knicks. Yeah, how is the fantasy ice hockey going, by the way? How's that going?
I think Jerry came in second.
Season's over.
Jerry, well done.
I lost in the finals to Mike's father. Not well done.
We've had me, Jerry, and my dad are always in the top 3, 4. Like, we're always doing well. My dad, I think Jerry's won it twice. I've won it once. My dad has won it 3 times.
Oh, jeez.
And he has a knack. He has a knack for it. He has no job. He's retired, so he has time to do this stuff.
You better keep it down, Mike. I believe you're in your family's house now, aren't you?
I suppose you're going to be fairly quiet. They're fine. They're getting old. They can't hear anything anymore anyway. They ask me every question 3 times. Like, I just told you, But that's only child stuff, too. Only child stuff, yeah. Yeah.
Yeah.
So yeah, hopefully the Knicks pull this off.
So-
They're on a Mulvaney heater right now. I think they have the best 10 or 12 game winning streak in terms of point differential in NBA history. Like, they're blowing people out. It's insane. So it's been fun. Like in and around New York City.
Go Tampa Bay Rays.
Oh God.
All right.
They are good though. They are scrappy. They're always there.
All right. Thanks a lot, guys. Good to be with you guys.
So, look, thanks everyone for attending, and thank you, listeners, for listening to this podcast. If you've enjoyed today's episode, please leave us a review wherever you listen to your podcast. Share it with a friend. And look, most importantly, stay systematic, stay patient, and may the trend be with you. See you, everyone. Bye-bye.
Thanks for tuning into Turtle Talk. If you enjoyed the episode, don't forget to rate and review the podcast. It really helps us reach more listeners. Share it with your friends and invite them to join the conversation. Got a question for us? Send it to info@aussieturtles.com, and we'll do our best to feature it on a future episode. Please note, Turtle Talk is for informational and educational purposes only. The views expressed by the hosts and guests are their own, and do not necessarily reflect the opinions of the podcast producers or affiliates. This podcast does not provide financial, investment, or professional advice. Always consult with a qualified professional before making investment decisions. That's it for today, folks. See you next time, and as always, may the trend be with you.